Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Monday, April the 8th, and it is Solar Eclipse Day. This is all over the news. People, there are whole festivals going on right now for people just wanting to go see the solar eclipse. So that's the good news. Solar eclipse out today. Unfortunately, maybe too cloudy to see it. We'll find out. But one thing is for sure, we will have more blind people tomorrow than we had today because they will go out and stare at the sun without any type of eye protection. So just always the case. But you know, it's interesting. My daughter called me from college yesterday. They don't have school today. They've completely canceled all classes today. Yeah, I'm shaking my head too. I'm like, honey, you do realize you're paying for college, and they've canceled all the classes so everybody can go see the solar eclipse. But look, if you miss it today, don't worry. You will have another opportunity 20 years from now. August 2044 will be the next solar eclipse. So there you go. I don't know. It seems like an awful, people are spending a lot of money. I saw a TikTok of a guy in Central Texas. He's got like 50 parking spaces on his property for $1,000 a piece. So, I don't know. It seems a little bit overboard to me, but that's just me, just whatever. Anyway, so lots of economic news out this week. We had lots of Fed speakers last week. And the message from all the Fed speakers last week was fairly uniform, which was, hey, we're going to cut rates, but we're not necessarily in a rush to do so. And because of that, the expectations for a June rate cut have now declined sharply, particularly following the very strong employment report of Friday. So on Friday, jobs number came out, 303,000. That was a 4 standard deviation event above the highest level of economist estimates. Now, interestingly enough, that number, that 4 standard deviation move on Friday, should be a rarity, right? A 4 standard deviation event is something that can happen, but should happen with rarity. So if you think about a bell curve, so you have kind of your normal events kind of in the middle of the bell, then on the very far ends you have these tails that are your exceptions to the rule, right? So a 4 standard deviation event is really far out there on that tail and should be something that happens once like every 20 years, right? Well, here's the interesting thing. We've had a 4 standard deviation event in the employment report for the last 3 months in a row. That is a statistical impossibility for that to occur. But yet that's happened. So a lot of people scratching their heads trying to figure out why that's occurring. And right now, and I've got an article coming out on Friday, talked about this. Newsmax asked me to write an article over the weekend, so I've been working on that. But I've got an article coming out on Friday talking about the impact of immigration on employment. And there's substantial evidence in the data that suggests that the immigration flows across the southern border are impacting these employment numbers and creating these outsized employment growth rates, at least temporarily. So it's kind of very interesting phenomenon what's happening, but the sheer magnitude of the beats in employment have been well outside the norm. And, can that consist? Can that continue, et cetera? And more importantly, what does that mean for the overall economy? Interesting survey out this morning. McKinsey did a survey of individuals, boomers, Gen Z, and millennials, asking them what they would be splurging on this year with their money, right? So previously, in previous years, it was travel, vacation, kind of that revenge spending that we saw coming out of the pandemic. And of course, a lot of people wanting to go out and, they've been locked up for 2 years, so they're going to go take trips. This year's big splurge for Gen Z and millennial. Brent, got a guess? What do you think this morning? What do you think Gen Zs and millennials will be splurging on this year with their money?
Food.
You're right. Absolutely.
Really?
Groceries. Number one answer for Gen Zs and millennials. Their big splurge this year will be groceries. So just goes to show you where we are. But see, the strong employment report ties into that, right? So we're seeing this very strong growth, but the problem is that if you have strong employment growth, you should have strong wage growth, and you're not having that. So as prices remain elevated, wages are declining, and that's really kind of pushing people to make these decisions about where to splurge and spend money on, and apparently feeding yourself is now becoming a luxury. So, and, this may have a lot of impact on the election coming up, so we'll see. All right, let's talk a little bit about the market on Friday, because we actually have something to talk about for a change. Woo! Right? For the last 3 months, it's been, hey, as long as we're on the 20-day moving average, don't worry about it. The market just keeps going up. Well, on Thursday, we took out the 20-day moving average. And now on Friday, we rallied back to it, and we're sitting right on it right now. So, technically, we haven't broken the 20-day moving average because we did reclaim it on Friday, but just by a smidge at the close. It was very, very close. So here we are, we're testing, and this is technically a test right now of that previous support. So this 20-day moving average has been consistent support for the market ever since really the November lows. And so we've had this massive flow of money coming in the market, and this has kept asset prices elevated. And so we've had this very strong level of support. Every time we've come down to the 20-day moving average, algorithms have kicked in. We started buying the market. Market went higher to the top of that trading range. So we've been talking about that. Well, over the last week, that trend has now changed to a degree. So we took out the 20-day moving average on Thursday. Now on Friday's stronger than expected employment report, stocks did rally here back. And again, we're sitting right on it. So here's the defining moment. Today, and this week, is the defining moment for the market. And this is important because as we start talking about potential corrections, those type of things, buybacks are in peak blackout period now for the next 3 weeks. So there's no blackouts at the moment. There's no buybacks going on for corporations. That's been a prime buyer. But those have been slowing down here over the last, really, as we got into April, over this first week of April. And interestingly, the market, because of that, has already been kind of setting up here for this bit of a decline. So we've had this very flattish top, and then on Thursday we broke that, and so now we've taken out this 20-day moving average. So what are we looking for now? And this is the important thing. So let's zoom in here a little bit so we get a little bit closer picture. So now that we've taken out this 20-day moving average, we rallied back up to it on Friday. So we're sitting right on it right now. If the market closes below that 20-day moving average, we come back down over the next few days and we close below that average this week, we will now have a confirmed, this is what I've been talking about too, we have a confirmed break of that support. So that's going to bring the 50-day moving average into focus pretty quick. So by Friday, if we have not reclaimed the 20-day moving average, we are probably going to see some lower prices in the markets. Now, in the real short term, we are oversold, and again, we got oversold on Thursday, and the market did bounce a bit on Friday. So we're seeing a little bit of buying pressure coming into the market. So again, this is why you want to be careful not to make a knee-jerk reaction. It's like, oh, Lance said if we break the 20-day, we're going to have a big correction. You got to wait. Got to wait for a second, because again, this is not uncommon that you can take out that support, immediately reclaim it, and then the market moves back up. So again, that could happen. And again, this will negate that break. However, by Friday, if we are still below that 20-day moving average, if we cannot reclaim it this week and we don't close above it, you'll now have a confirmed break, and that would suggest lower asset prices, and again, kind of that beginning of a bit deeper correction in the market. So again, pay attention. This could be a very important week. We'll keep up to date on this. Futures right now are pointing up, so we may move right back into this kind of trading range today. We'll see. We'll talk about it tomorrow. I'll keep you up to date, but that's what you need to know before the bell this morning. All right, when we come back, we'll talk a little bit about inflation and interest rates. We'll cover that in the newsletter this weekend. Don't go away. You're listening to The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome to the show this morning. I don't hear a thing going on at the moment.
You can't hear it all, anything
I hear
at all?
nothing. I hear nothing. I don't even hear you. So,
Well, that's bizarre.
yeah.
Well, act as if you can, because
I will just wing it, and we'll see what happens.
the whole world is watching.
Yeah. Well, so if you don't understand how the show works, is that I listen for cues in my earpiece, and I just fixed it. I can hear it now. So,
You're amazing.
yeah, it's all good. So, but yeah, so I listen for cues from Brent, either the start of the music or whatever it is, and that tells me when I have to leave a segment. So, again, it's important that I hear things. Not that I need to, but, it helps.
And in case you ignore that, I hold a fist up at
Exactly.
30 seconds before.
Or my favorite digits, one of the two. So, anyway, so in this weekend's newsletter, we covered inflation a bit because we saw the CPI report come out recently, and this is, interest rates have come up a little bit over the last, couple of weeks. Everybody's kind of like, kind of freaking out over that, and we're starting to see, just every time interest rates even tick up a smidge, right? We get just tons of reports about, inflation's coming back and interest rates are going off to the moon. None of that's happening, right? But, so just wanted to kind of calm some fears. And so over the weekend, we went through the analysis of inflation and interest rates and the correlations. And, but again, there's no doubt inflation did come in a bit hotter than expected in the most recent report. And when you take a look at the CPI index and look at its month-over-month rate of change, it did tick up. And where we are right now is pretty much right in line with kind of the average trend of inflation over time on month-to-month changes. Now, this is important. This is just the one change from one month to the next. And nothing in inflation or the economy is ever flat, right? It's just, you're not going to print 0.2% every single month. But these changes are important because of what we're comparing to. And again, this is the thing we have to remember about the way that we measure inflation is we compare on a year-over-year basis. So where was inflation this time last year? And inflation was still a lot hotter. and a lot higher, right? We were at coming off of 9% inflation and working our way lower. And so if we start to look at inflation from kind of that term of the actual measure of inflation itself, inflation is still trending lower, right? And that's what we would expect. But the rate of decline is going to slow down. And there's a couple of reasons for that. First of all, the economic growth has been substantially stronger than expected. And again, this has a lot to do with the report that I'm writing about next Friday on immigration and that impact on the economy because they spend money, right? We're giving immigrants money to spend. We're paying for housing. We're paying for food. We're paying for healthcare services. We're paying for phones. We're giving them cash to spend. We're paying for bus trips and airline fares. That's money getting spent in the economy by the government. So that boosts economic activity. And so we've had this very large surge of immigration over the last 2 years. And again, there's a lag effect from this. So when they start spending money, it takes time to show up in the economy. So all that money that was spending really started to show up in the economy in the third quarter of last year. Third quarter, fourth quarter, first quarter this year has been very, very strong. And so not surprisingly, that's keeping inflation a little bit stickier here than expected. But the overall trend of inflation is still running lower. And so we're going to wind up sub 3% by this time next year. And we'll be working towards the Fed's goal of 2% ultimately following that. So, the trend of inflation is still declining. And this is very important to remember because, as we take a look at inflation and the way that it's calculated, there's some important aspects to what's doing. So let's actually take a look at inflation from last month, right? And kind of the breakdown. So this is the breakdown of the components of CPI, how we calculate it, and its weighting. Housing makes up 44.6% of that. That includes utility cost, those type of things. So energy is a function, right? People talk about gasoline prices, et cetera. That's not really, energy is not a component of CPI directly. It doesn't have its own weighting. Energy is calculated in utilities, which is in housing, gasoline, which is in transportation. So energy's in there. So the change in energy prices is important because it affects it, but it doesn't have its own category. So it's embedded in these other areas. But if you'll notice, last month, the inflation declined. Now, we don't have the March out yet, so we're still talking about February. Inflation declined in every area except transportation and healthcare costs. That's not unsurprising because what happens at the beginning of every year is that healthcare resets. So everybody goes in on October, November, and you have to re-register for your healthcare benefits at work, change out your plan, whatever you're going to do, and then you get the new rates come January, right? So your new rate is X, and so in January, February, all those rates go up. But they're locked in for the rest of the year. So the surge in inflation and healthcare costs will stabilize over the rest of this year because all these new pricings are in. But housing, apparel, food and beverage, those all declined over the last month. Yes, eggs are still expensive, but they're not as expensive as they were previously. They've come down in price some. Gasoline is up because oil prices are up right now. A lot of tension in the Middle East, so that's giving us some impact. So you're going to have these variabilities, but the big thing to watch is housing because that's 44% overall of the overall index. And so housing prices are and homeowners equivalent rent as a function is going to decline because we have an overbuild of multifamily apartments. We've just built a slew of multifamily apartments. There's an oversupply of apartments. That oversupply is going to lead to lower rents. That's going to be reflected in the housing components of CPI over the next year or two. Again, this takes time. It doesn't happen overnight. So importantly, and as the Fed cuts rates, that's going to lower the impact on the economy because they'll be cutting rates to offset further weakness economically. So if the Fed is cutting rates, you're going to have slower rates of economic growth. And that's why right now, the expectation of a rate cut's getting kicked out past June because of the employment reports. Right now it's extremely strong, so no reason to cut rates right now. But if we take a look at inflation, there's kind of three measures we can look at. So we have our core CPI, we have CPI, which is the black line, and that's, still over 3% right now. We have the blue line, which is core CPI. It's a little bit higher than the actual headline CPI number, so core CPI has been a little bit stickier. But if we take a look at inflation for the average household, right, that's a little bit different. For most Americans, right, whether you rent an apartment or have a mortgage payment, your housing costs are fixed. The only thing that varies in your housing costs from one month to the next is your electric bill and utilities, those type of things. Your healthcare costs are fixed for most Americans, right? You sign up for your healthcare plan in October, November, December. Come January, you get your new pricing, and that's what you're going to pay every month for the rest of this year. So yeah, in the beginning of the year, you've had inflation and healthcare costs, but for the rest of this year, that's it. It's done. There'll be no change. And for the rest of this year, the payment's going to be exactly the same for the rest of this year, and then it'll adjust again next year. So if we back out housing payments, and again, whether you rent, that's contractually fixed. Your mortgage payments, you don't get an adjustment to your mortgage payment every month, right? So if we subtract those things out, the inflation rate for the average household right now is about 2.5%. And this is because of those things being actually fixed. So for the average American, yeah, inflation is still there. Things cost more than they did back in 2019 for certain, right? No doubt about that. And over the course of the last couple of months, we've kind of stabilized around this 2.5% mark. So the point is that despite these little upticks that we get from one month to the next, right? Inflation is still is being sticky right now, but the trend is still lower. And it's going to be that way for a while. I know that's kind of hard to get your head around, but there's a very basic premise behind inflation, and that's supply and demand. And we go back to basic economics school, and we understand where inflation comes from. And so you have supply and demand. And when we shut down the economy, we restricted supply and boosted demand by having stimulus checks and money and everything else flowing everywhere. And that's still going on right now. We still have a lot of stimulus still in the system that's floating around. It's coming out, right? Savings rates are falling, et cetera. But now again, with the immigration, we're spending a lot of money there at the moment, billions. And that's helping keep some of these prices elevated. But supply is rising. If you take a look at retail sales and inventory, that inventory is rising sharply. So we're reversing that restricted supply. And so prices will eventually begin to fall as supply outstrips demand. And again, because of where prices are, because of restricted savings and those type of things, demand is going to decline. Now, this is not going to happen tomorrow or next week. This is going to happen over months. And we're talking about next, by the time we get to next year, we're going to see restricted demand against increasing supply, and that's going to lead to a slower rate of inflation. All right, quick break. We'll come back. We'll finish up how this impacts interest rates. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today today for our open season candid coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If you take a look at a lot of these videos that are getting put out on TikTok, it's like, working for the rest of my life, I'm just supposed to do this forever because I need money. The struggle is real for the new generation, which is now learning that 9 to 5 isn't as easy as going to college.
The Real Investment Show podcast. Same show, your schedule.
My daughter, she's 17, and she's discovered Kroger points for getting a discount on gas.
At realinvestmentadvice.com.
The struggle is real.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Let me clear something up for you real quick. I was just over the break reading some of your comments in the YouTube chat, which, feel free to join, chat in the YouTube. I do pay attention to it. You have to understand that there's two things that we're talking about here. So there's real inflation, and then there's the inflation that matters to the markets. Okay? We're talking about the inflation that matters to the markets. For you personally, your inflation rate is different than everybody else's. Your personal inflation rate is different than your neighbor's. Your personal inflation rate is different than mine because we live differently. Everybody does, right? What you choose to spend money on and what you choose not to spend money on, that's your personal preference. I keep my house, the temperature in my house around 75. Brent keeps his at 47. So his electric bill is a lot higher than mine, right? So he has inflation in electric bills. But he likes to wear a parka in the middle of summer. I don't know why, but, he does. My wife and I, we've just acclimated to higher temperatures in our house because we don't like paying electric bills, right? So that's just, and so you have to understand that your personal rate of inflation may be very high, and you may be experiencing things. And again, one of the comments is wait till I have to buy coffee and chocolate. Well, I don't buy chocolate, but I do buy coffee. And yeah, coffee prices have gone up. Absolutely. Right? But that's my if I drink a lot of coffee, which I do, I spend more on coffee than somebody else who doesn't drink coffee at all. So everybody's personal inflation rate is very different. We're not talking about that. Don't care what your personal rate of inflation is. What I do care about is what the market's measure of inflation is. And the only thing that matters to the market is CPI. Doesn't matter what your personal inflation rate is. The only thing that matters to the market, to the bond market, to the stock market is CPI. So it doesn't matter whether or not you believe CPI is real or not. Doesn't matter, because that's what the market pays attention to. So understand the difference is that the only thing that matters to the market and the only thing that matters to your money, which is what we're talking about here, is CPI. And so that goes back to the supply-demand imbalance that goes on. And the reason that it's important to understand basic economics is because when that curve shifts, inflation comes down. When it shifts back in the other direction. In other words, as supply rises and we have a constriction in demand, which is going to come. So if we take a look at the personal savings rate versus GDP, those are declining sharply. And so as those decline, this is your demand factor. So as demand declines and you have increased supply, prices will fall. Maybe not tomorrow, but basic economics. And so the important thing about this is that as these things occur, you're going to have less demand. Take a look at retail sales as an example. So this is retail sales, seasonally adjusted annual basis versus the 12-month rate of change. Retail sales have dropped sharply. Demand is declining. So yeah, we're getting some anomalies in inflation short term in terms of education, in terms of healthcare at the moment because of the resetting of prices. But the demand side of the equation, again, what's the big splurge for Gen Zers right now? Groceries. That's their splurge, which means if that's their splurge, what are they not doing? They're not going to be traveling. They're not going to be going on vacation. They're not going to be, buying, whatever. Demand is going to decline. As demand declines, so does prices. Economic growth is running well below trend, even now. And that's going to be the case going forward. So you've got below trend growth. Starting back in 1947, the economy was growing at about 3.2% on a real basis. After the financial crisis, we dropped that to about 2.2%. After this crisis, we're going to be running, closer to 2 than even 2.2. So every time we've had a crisis of some sort, we run at a lower rate of economic activity. Slower economic growth, increased inventories, slower spending. That's going to drive inflation lower. And we can prove this, right? Let's not forget about the debts and the deficits. Well, debt is a problem long term because when you have exceeding levels of debt in the economy, that detracts from economic activity. So you have to understand how debt works. Debt supply is a short-term boost. So we've issued a lot of debt to fund the CHIPS Act, the Inflation Reduction Act, all that. That's all created stimulus into the economy, which has given us this boost of activity along with this immigration flow. But now we have to service that debt, which new revenue that's coming in that could be used to support the economy is now going to get diverted to pay interest on the debt. And we're going to have to issue more debt just to service the interest, which means we have less debt to issue to go service the economy, etc. And so when you have this increase in debt, and when debt exceeds the 100% of debt to GDP threshold, you get slower rates of economic growth. Again, slower rates of economic growth leads to what? Lower prices. So this is the important thing. And that, look, if we build and we can prove this because if we build a composite of inflation, CPI, and economic growth, then interest rates are exactly where they should be right now. So interest rates are a reflection of economic growth and inflation. It took a while for interest rates to catch up with what was going on with economic activity and inflation, but now they've converged. So as GDP and inflation continue to decline, interest rates will begin to decline further with that. And in fact, if we take a look at the long-term correlation of that, there's about an 88% correlation between GDP and CPI and interest rates. It's a very high correlation. So the issue is that yes, in the short term, we have inflation, no doubt about it, right? But that rate of inflation is declining. And it's declining because you've got lower rates of economic activity. And the more pressure that you put on the economy, the slower the rate of economic growth you're going to get. Now, again, we have lots of short-term variabilities that occur, right? New debt issuance, more spending, some new bill. President Biden just came out over the weekend and says he's going to forgive, 30 million borrowers, some more student loan debt. We keep trying to do that. That's great, right? All short-term benefits. The long-term dynamic remains the debts and the deficits, which is going to lead to slower rates of economic growth, declining savings rates, slower economic activity, replacement of workers with more productive investments like AI, gives people less consumption. All those things lead to lower rates over time. You just have to understand how that works. So again, it doesn't matter what you personally think inflation is doing in the short term. And we do have inflation right now. No, I'm not saying there's no inflation, right? We're talking about the long-term dynamics here. And, the issue is that, every time inflation ticks up a little bit, which it's going to, nothing goes in a straight line in one direction or the other, right? It doesn't go straight up. It doesn't go straight down. You're going to have these little variability bumps. And then every time you have this little bump in inflation, you're like, oh my God, inflation's coming back. Yes, in the short term, that's going to happen. You're going to have little bumps in commodities. You're going to have, stuff like that, right? It's just going to happen. You're going to have that kind of action with production. Companies are going to produce stuff to the point that they have inventory. And then if they're concerned about the outlook, they may kind of crimp that consumption, that production a bit to make sure they don't have too much inventory. They're going to try to manage those inventory levels. But at some point, I can cut back on my inventory to a point until I've got to replace that inventory. And we're seeing that with the manufacturing indexes right now. ISM has turned positive. ISM manufacturing has turned positive after months of being in decline. So for months and months and months, people were cutting back on new orders and not buying a whole lot of inventory and kind of working off those excesses from 2020. But now they've gotten to the point that I got to have some stuff. And if I'm in the construction business, construction has been doing well, so I've got to buy some product. And so we're starting to see manufacturing turn up here a bit. Not surprising. Everything cycles. Sustainability is the question. So if you're betting on higher inflation, right, if that's your bet, what you've got to come to grips with is how do you get stronger rates of economic growth from here? Right? That's got to be that you've got to have the fundamental basis for stronger economic growth from here. And we're currently running about 3.5%. So you're going to have to figure out how to get to 4 or 5% economic growth if you're expecting 5% CPI. And conversely, 5% interest rates, because they're going to align. So if you can come up with that math, and if you can build a thesis that says you have stronger versus weaker economic growth, then you'll be right. You'll have higher interest rates and higher inflation because it's all supply and demand. So that's got to be your premise. Everything else that you can come up with doesn't matter. You've got to come up with a basis for stronger economic growth to get to higher inflation and higher interest rates. All right, be right back. We'll wrap up the show.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So talking about economic activity, one of the things that has been a big support for the economy over the last, couple of years has been just a unprecedented amount of debt issuance that's been farmed out through the economy through things like the Inflation Reduction Act, which sent tremendous amounts of money into, green projects. Whether or not that they're profitable or whether or not they provide any benefit is a different issue. But that's where we spend a lot of money. So when you spend money in the economy like that, you get a short-term boost of activity. One of the things that has been talked about for decades, and every time that you have somebody running for president, they always talk about we need to fix the power grid, right? We never do it, but we always talk about it. We need to spend money on fixing the power grid. And now with this artificial intelligence shift that's coming, that's going to consume an immense amount of power. So one of the things coming up in coming years is going to be a forced function of fixing the power grid and increasing it. Use of nuclear, a variety of other endeavors to increase the amount of electricity that's available to power AI. And, there's no free lunch, right? So when we talk about these innovations, they're great, but there's a cost to all of these innovations. And so we're going to have to spend money. And so there's, as we've talked about before, there's productive uses of debt and there's unproductive uses of debt. Unproductive uses of debt lead to lower rates of economic growth because they don't produce an income stream going forward. Rebuilding your power grid is actually a productive use of debt. That would actually be good for the economy. Yes, you create jobs in the short term, but the people using that electricity pay fees going forward for the uses of that infrastructure. So the debt repays itself over time. So rebuilding the power grid is actually going to be a benefit economically long term, even though it will require a lot of debt to do it up front. But again, these are promises always made, but we get sidetracked by needing to use the money for short-term benefits to get elected. So we're going to do things like forgive student loan debt, those type of things, somebody's got to pay for that debt, right? So taxpayers wind up paying for the debt. The debt's still there. The debt doesn't get magically erased, right? It just doesn't vanish. The debt's got to be paid back to the people that loan the money. And so whether it's the Treasury or the Fed or whoever, it doesn't matter. Somebody owns those bonds, and those bonds have to get paid off. So, yeah, the students may not have to pay off that debt, but somebody is, and that's going to be the taxpayer. CHIPS Act, another round of billions of dollars that we spent on trying to onshore some of the building of chips. So, Intel's gotten approved $6, $7, $8 billion, I can't remember, to build chip foundries here in the United States. Taiwan Semiconductor, the U.S. government just offered Taiwan Semiconductor $6.6 billion to build factories in Arizona. So that'll be a boost, right? So we're going to build a factory in Arizona. Now, it takes about 10 years to grow a chip, so this stuff doesn't happen overnight. But we're going to create a lot of short-term jobs and employment, construction, etc., to build these plants when we do this, right? So again, it's use of debt to build something. And so we're gonna manufacture this plant here to manufacture chips over the long term. So I mean, there's nothing wrong with that, right? But when it comes to economic growth, inflation, interest rates, again, this is why we continue to see this kind of environment that is seeming to kind of defy rationality of what's going on. And we get these knee-jerk reactions all over the board. So the stock market, the bond market, whatever, it's just, they're all kind of knee-jerk reaction. Right now, the bond market's not paying attention to higher interest rates. They will, probably around about 4.8%. If you get there on the 10-year Treasury, the stock market is going to matter a lot. That could happen by summer, right? Going into the election. Not going to be good for the election, but again, we've been talking about we're going to have this 5 to 10% correction. And if I was Joe Biden right now, I'd be wanting that correction to happen right now so we can get it behind us and then start rallying into the election. But the longer this thing gets postponed to keep the market elevated, and the closer you get to the election, the sell-off going into the election is going to be worse for the votes. So, this, and right now that correctional phase looks like it's going to probably take place later rather than sooner. We'll see. I mean, maybe it's starting now. We'll see. We'll see what happens. But, historically speaking, summer months, and particularly the summer months prior to the election, tend to be the weakest, and that's where you tend to get your biggest correction heading into the election. So, but, right now, the important thing is that despite the headlines, right? And again, despite, and this is what I was saying earlier, hey, I appreciate the stuff that y'all put in the YouTube chat, right? Y'all make good comments. But again, you have to understand there is a big difference between what you think and what the market cares about. And what the market cares about, you may not believe the employment reports. Doesn't matter what you believe, right? The market looks at the employment report. The market is driven off the BLS employment report. The market's driven by CPI. These inflation, these governmental inflation and governmental reports. That's what drives the market. It doesn't matter what you think. It doesn't matter whether you believe these reports or not. Look, there's a lot of problems with the employment report. There's a lot of problems with the inflation report. Again, that's true, right? I don't disagree with you. And that's why there's all that. And look, as long as I've been in this business, over 30 years, people have complained about the CPI report. In 2000, people were complaining that the CPI report had nothing to do with what was going on with inflation in the real economy, right? 2008, people were complaining about the inflation report and had nothing to do with what's happening in the real economy. Bill Dudley famously quoted saying, hey, your iPad is cheaper. And a reporter yelled at him in 2008, yeah, but you can't eat an iPad. So people have complained about the inflation report for decades. And it's detachment from what happens in the real world. And that's true. But it doesn't matter. All that matters to the market and your money, and again, why you're listening to the show, is trying to figure out what's going to happen with the markets and your money, right? The only thing that cares about The only thing the market cares about is the official reports. And most importantly, what does that official report mean for the Fed? Is the Fed going to cut rates or not? And right now, interest rates are ticking up because all of a sudden, the Fed may not cut rates in June because of this recent employment report. Might be September before they cut rates. Might not even be this year before they cut rates. So we could very well see interest rates tick up here in the short term, but that's not going to change the long-term dynamics of impacts of declining savings rates, falling wages, economic growth, etc. Those are all going to slow down. Again, we have supports that will keep them elevated for longer than expected, but they're still going to slow down because of the sheer dynamics of the debt. So just keep that in mind, right? And again, it's important that we differentiate between our personal experiences and what the market cares about to make you a better investor over time. And again, if you're day trading, who cares, right? None of this matters. If you're a short-term day trader and you're trading from one day to the next, or you're just trying to hop on the latest trend, whatever it is, none of this matters. I wouldn't even pay attention to this data. You just find what's moving up. You set a set of momentum indicators, a couple of technicals, and you buy whatever's moving in the right direction, right? So if that's your investment style, more power to you. Nothing wrong with that. But none of this matters, right? Just focus on what's happening in prices. If you're a long-term investor like we are, then these things matter. And we have to look through what's happening short-term to understand what the long-term dynamics are, because that's where our bets are. Our bets are 3 and 5 years out, not 3 months out. So again, just differences of opinion. That's what makes a market, obviously. But it's also making sure and aligning what you're doing with your money relative to the duration and the time frames and the things that are important that align with your goals with your money, whatever that is. Okay, enough of that. Get ready to wrap up the show for today. Futures pointing, they're flat, right? We'll see what happens. Interest rates on the bond market are up a little bit this morning because of the employment report on Friday, and now this kind of repricing of the Fed. So we're going to see a little bit of volatility this morning. Again, don't read too much into it. What matters is where we finish on Friday. Because, again, if we're looking for a correction to start here and we've taken out that 20-day moving average, we've got to confirm that break. And as I said at the opening of the show this morning, we'll only confirm that break at the end of the week. So on Friday, if we're below the 20-day moving average, we have a confirmed break. That's what you're looking for. You're looking for how we end the week. That's the important thing. So again, nothing to worry about today. We'll see how things go. Again, futures kind of all over the board right now. So again, how we open and where we close today, two entirely different things. All right, wraps up the show. We'll be back tomorrow. I've got a report on margin debt tomorrow that we'll discuss with you, and more about the markets and keep you up to date. Be sure to like and subscribe to the channel. We'd love to have you here. Your support is always greatly appreciated. Get by the website, realinvestmentadvice.com. All the charts and graphs on interest rates and inflation is in this weekend's newsletter on the website right now, realinvestmentadvice.com. Have a great day. See you back here tomorrow.